Forex, short for foreign exchange, refers to the global marketplace for trading national currencies against one another. It is one of the largest and most liquid financial markets in the world, with a daily trading volume exceeding $6 trillion. Here's an overview of key aspects of Forex. 1. Market participants. The Forex market is composed of various participants, including banks, financial institutions, corporations, governments, and individual traders. These participants trade currencies to conduct international business, hedge risks, or speculate on currency price movements. 2. Currency pairs. In Forex trading, currencies are traded in pairs. Each pair consists of a base currency and a quote currency. For example, in the EUR-USD pair, the euro is the base currency and the US dollar, USD, is the quote currency. The price of the pair indicates how much of the quote currency is needed to buy 1 unit of the base currency. 3. Trading hours. The Forex market operates 24 hours a day, 5 days a week. It is divided into major trading sessions: the Asian session, the European session, and the North American session. This continuous operation is due to overlapping time zones and the global nature of the market. 4. Leverage and margin. Forex trading often involves the use of leverage, which allows traders to control larger positions with a relatively small amount of capital. Leverage is expressed as a ratio, e.g., 51:101. While leverage can amplify profits, it also increases the potential for significant losses. 5. Market influences. Various factors influence currency prices, including economic indicators like GDP, employment rates, inflation, geopolitical events, interest rates set by central banks, and market sentiment. Traders analyze these factors to predict currency movements. 6. Types of analysis. Traders use different types of analysis to make informed decisions. Fundamental analysis examines economic indicators, news events, and financial statements to forecast currency movements. Technical analysis uses historical price charts and indicators to identify patterns and trends. Sentiment analysis gauges the mood of the market participants and their potential impact on currency prices. 7. Risks. Forex trading carries significant risk due to its volatile nature and the use of leverage. Traders can lose more than their initial investment if not managed properly. Risk management strategies, such as stop-loss orders and proper position sizing, are essential to mitigate potential losses. 8. Regulation. The Forex market is decentralized, meaning there is no central exchange or regulatory body overseeing all transactions. However, regulatory bodies in different countries oversee Forex trading activities to protect investors and maintain market integrity. Overall, Forex trading offers opportunities for profit, but it requires a solid understanding of the market dynamics, disciplined trading strategies, and effective risk management.